What if everything you think you know about the silver market is already outdated? What if the numbers flashing on your screen are showing you a version of reality that no longer exists? Before we go any further, yes, this is a new look. Same avatar, clearer signal. There has always been a real analyst behind this channel. I changed the presentation because credibility matters, and I wanted something that actually reflects who I am. Welcome back to Metals and Markets. What I'm about to share is not hype, not theory, and not something you will hear repeated on financial television. It is midday on the East Coast as I record this, and something just happened that I have never seen before in over 12 years, analyzing commodities and accumulating physical silver. About 3 hours ago, I was watching the silver bid price move in real time, and it crossed $9.45. That represents a vertical move of more than 40% in a single month. Financial media is already scrambling to explain it away, calling it speculative excess, emotional panic, or a replay of 2011. Familiar narratives meant to make you doubt your own eyes. They are telling you to wait for a correction. They point out that silver mining stocks are up only 16%, while the metal itself has surged more than 40%. They use this 25% gap as proof that the rally is artificial, unstable, built on sand. But what they completely miss is that they are analyzing the market through a rearview mirror. The real story is not the price quote on your screen. The real story is unfolding quietly in vaults, warehouses, and physical exchanges across the world. Physical silver is becoming something I can only describe as unobtainable. Forget the paper price for a moment and look at the empty shelves, the shrinking inventories, and the strain in the supply chain. The disconnect between the metal and the companies that extract it from the ground has reached a violent breaking point, and the catalyst behind this rupture is not speculation or retail frenzy. We are approaching what I call the Hoover Dam moment, when pressure builds silently until the structure can no longer hold. Right now, silver has risen more than 40%, yet the major silver miners tracked by leading ETFs have moved less than half that amount. That gap is not a warning sign. It is the most compressed spring I have seen in more than a decade. The entire global silver mining sector is valued at roughly $300 billion, less than a single large technology company. An entire critical industrial metal industry is priced like an afterthought, and that imbalance is where the real story truly begins. Here is the part most people are missing, and it is critical. This disconnect between silver and the miners is not random, and it is not temporary noise. It represents the most extreme form of operational leverage I have ever seen in this sector. The global silver mining industry is tiny by capital market standards, yet it produces one of the most strategically important metals on the planet. When a sector this small experiences a structural shift in pricing, the result is never gradual. It is sudden, violent, and deeply misunderstood until after it is over. To understand why this matters, you have to understand how mining actually works. Mining companies operate with costs that are largely fixed: fuel, labor, equipment, processing, maintenance. These expenses do not magically rise just because the metal price goes up. So when silver moves from $55 to over $90, every single dollar above that fixed cost turns into pure profit. This is not speculation. It is mathematics. And mathematics does not care about sentiment, headlines, or analyst opinions. Think about it in simple terms. If it costs roughly $20 to produce 1 ounce of silver, then at $55 the miner earns $35 per ounce. At $93, that profit jumps to $73 per ounce. That is a 69% increase in price, generating more than a 100% increase in profit. Yet the market is still pricing these companies as if silver were stuck in the old range. The earnings reports simply have not caught up yet. And that delay is not because the numbers are wrong. It is because we are between reporting periods. Analysts have not updated their models because they do not believe the price is real or sustainable. They are anchored to the past. But reality does not wait for consensus. When these companies report a full quarter selling silver above $90 while costs remain fixed, The shock will not be subtle. It will hit earnings statements like a runaway train. This is why focusing only on price charts misses the point entirely. Price is only half the story. The other half is margin expansion, and margin expansion is already happening in real time. The market just has not acknowledged it yet. That is how asymmetry is born. Not when everyone agrees, but when the data is obvious and ignored. That is where we are right now, standing at the edge of a repricing event that most participants are still refusing to see. The price surge alone would already be significant, but it is not the most important signal right now. The real warning light is flashing in the physical markets, far away from Western headlines. While paper silver trades around $94, the Shanghai market is paying more than $103 per ounce. That $9 premium is not a rounding error. In physical commodities, a premium of that size is a gravitational force. It pulls metal across oceans, drains inventories, and exposes where real demand exists. When arbitrage like this appears, it does not fade quietly. Traders buy silver in New York or London at the lower price and ship it east to capture the premium. They repeat this process relentlessly until inventories are exhausted. This is not theory or speculation. It is already happening. Western vaults are being emptied in real time, not because of panic, but because the math guarantees profit. When enough metal leaves the system, paper markets begin to crack under their own weight. Now look at the retail side, because this is where the situation crosses from tight into abnormal. The largest precious metals dealer in the world has imposed a $500 minimum order on silver purchases and publicly admitted that output will be cut in half due to supply chain disruptions. You cannot buy a few coins anymore. That is not normal market behavior. That is rationing. I have been accumulating physical silver for more than 12 years, and I have only seen conditions like this during periods of extreme stress. This matters enormously for mining stocks because institutions cannot simply replace physical exposure with bullion anymore. Pension funds and large investors cannot buy 50 million ounces of silver that does not exist, but they can buy $10 million worth of mining equities in an afternoon. As physical silver becomes harder to source, miners become the only liquid proxy. That door is narrowing, and most of the market has not realized it yet. People assume that when prices rise, supply will magically respond. But mining does not work that way. There is no switch you flip to create more silver. Even if prices doubled tomorrow, it would take a decade or more to bring meaningful new supply online. Exploration, permitting, financing, construction. All of it takes time. The shortage we are seeing now was built over years, and it cannot be solved quickly, no matter how high the price goes. At this point, the main counterargument always surfaces. Intelligent people argue that a deflationary shock or a broader market crash will force investors to sell mining stocks to cover losses elsewhere. And that risk is real. We saw it in 2008 and again in 2020. Margin calls do not discriminate. When liquidity dries up, everything gets sold. I am not dismissing that scenario, but what those arguments ignore is the structural deficit underneath this market, and structural problems do not vanish in a liquidation. In 2025, the silver market ran a deficit of roughly 150 million ounces. That marked the 5th consecutive year of shortage. You cannot print silver to compensate for more than a decade of underinvestment in exploration and development. High prices do not fix this quickly. That idea works for software and consumer goods, not for mining. Even if silver reached $200 tomorrow, meaningful new supply would not arrive until well into the next decade. This is why the common strategy of waiting for silver to fall back to $60 may fail entirely. What if that price never returns? What if physical scarcity creates a new floor? That possibility is not being priced in at all. The market is still assuming a reversion to old norms that may no longer exist. If the floor has moved upward due to physical constraints, then current valuations are not just wrong. They are dangerously outdated. Even in a pessimistic scenario where silver corrects 20% from current levels, the math still does not work in favor of the skeptics. At $75 per ounce with production costs near $20, Miners are still generating margins far above what Wall Street models assume. That means these companies remain undervalued even after a pullback. The downside is limited by structure, while the upside remains wide open. This is what makes the current setup so asymmetric. The metal has already moved. The physical market is signaling stress. Profits are expanding in real time. Yet equity valuations remain anchored to a past that no longer reflects reality. When markets ignore math for long enough, the correction is never gentle. It happens quickly, violently, and usually when most people least expect it. What we are witnessing now is a historical anomaly. Physical silver has climbed more than 40% in a single month, while the major silver mining equities have advanced only a fraction of that move. This kind of divergence almost never persists. When it appears, it signals that the market is either pricing in a collapse that never comes or failing to grasp the profit implications unfolding beneath the surface. Given the structural deficit, the physical premiums, and the retail shortages, the odds strongly favor a violent catch-up rather than a breakdown. Quarterly earnings are the ignition point. Right now, analysts are modeling these companies as if silver were still trading in the mid-50s. Those assumptions will not survive contact with reality. When miners report a full quarter of sales above $90 per ounce, while costs remain largely fixed, profit growth will exceed 100% year over year. At that moment, the 25% valuation gap will not close slowly. It will disappear in a matter of days, not months. Markets reprice faster than most people can react when hard numbers invalidate old models. Analysts rush to revise forecasts, price targets are raised in rapid succession, and institutional capital follows confirmation, not intuition. This is when volume expands, spreads tighten, and liquidity vanishes for late entrants. The window does not close politely, it slams shut. Anyone waiting for headlines or official upgrades will be forced to buy at significantly higher levels. This is also the phase where psychology flips. What was dismissed as speculative suddenly becomes obvious in hindsight. The same voices that warned of collapse begin explaining why the move was inevitable. But by then, the asymmetric opportunity is gone. The easy money is never made when consensus arrives. It is made in the quiet period, when the data is clear but ignored, and conviction still feels uncomfortable. Right now, we are still in that uncomfortable window. Profits are expanding, inventories are shrinking, and valuations are frozen in an outdated framework. The disconnect between reality and pricing is not sustainable. When it resolves, it will do so decisively. The only question is whether you recognize the shift before the market forces everyone else to acknowledge it. What happens next is where the scale of this move becomes difficult to grasp. Institutions are starting to realize that silver is not just a commodity trade, but a hedge against persistent monetary debasement. Not temporary inflation, not something central banks can fix with a couple of rate hikes, but structural inflation embedded after decades of currency dilution. In that environment, tangible assets matter. And silver, sitting at the intersection of industrial necessity and monetary history, becomes unavoidable. Run the math on a single large pension fund. A fund managing $100 billion that allocates just half of 1% to silver needs $500 million of exposure. $500 million represents roughly 10% of the total market capitalization of the primary silver mining ETF. One fund. One modest allocation decision. Now imagine several funds reaching the same conclusion, or sovereign wealth funds following suit. The supply side of this equation does not move. You cannot manufacture more mining shares on demand. You cannot instantly increase silver output to meet capital inflows. When institutional money begins to flow, it collides with a fixed and narrow market. That is when liquidity disappears. Prices gap higher not because of emotion, but because there are simply not enough shares available at previous levels. This is how small sectors behave when large capital wakes up. I am watching 3 indicators closely to understand where we are in this cycle. First, the Shanghai premium. As long as that premium remains elevated, it signals that physical reality is still overpowering paper pricing. Second, retail rationing. Minimum order sizes and inventory outages are early warnings that stress is spreading. Third, earnings momentum. When profit growth becomes undeniable, denial ends quickly. This is the transition from a speculative narrative to a survival market, from abundance assumptions to scarcity recognition. The exit door narrows quietly at first, then suddenly. By the time most investors understand what is happening, the positioning window will already be gone. That is how these cycles always work, and this one is no exception. At this stage, it becomes necessary to think in phases, because this kind of revaluation never unfolds in a straight line. Markets move in waves, and each wave attracts a different type of participant. Right now, we are still in the early phase, where positioning happens quietly and conviction matters more than confirmation. This is the phase most people miss because it feels uncomfortable. Prices have moved, but not enough to feel obvious. The data is clear, but not yet validated by authority. The first phase is accumulation. Physical silver is already tight, miners are still lagging, and informed capital is building positions ahead of earnings. This phase ends when quarterly reports force analysts to update their models. The second phase is institutional recognition. This is when pension funds, endowments, and large asset managers begin allocating capital in size. You will see it in volume. Daily trading activity will multiply, and price discovery will accelerate. The third phase is the one everyone remembers. This is the mania phase, when retail investors flood in, media coverage turns enthusiastic, and silver mining stocks become dinner table conversation. That is also the phase where discipline matters most, because nothing rises forever. Excess always corrects. But we are not there yet. Right now, we are still in the phase where quality matters more than quantity, and patience is rewarded. Of course, no thesis is without risk. A severe deflationary shock could temporarily drag miners down with the broader market. A sudden credit crisis could force indiscriminate selling. But even in that scenario, the structural deficit does not disappear. Industrial demand does not vanish. And physical scarcity creates a price floor that did not exist in previous cycles. Even if the timing is imperfect, the math remains unchanged. These companies are generating profit growth that exceeds 100% at current silver prices. That is not a forecast. It is already happening. Markets can ignore reality for a while, but they cannot do so indefinitely. Eventually, price follows truth, and when it does, it rarely moves slowly. There is another signal that rarely gets discussed, but it matters more than most headlines: insider behavior. When executives and board members of mining companies start buying their own shares with personal capital, that deserves attention. These are the people who see production numbers before anyone else, who understand cost structures in detail, and who know exactly how margins are evolving. Insider buying does not guarantee success, but it often reveals confidence when valuations are disconnected from reality. Over the past several weeks, multiple executives across primary silver producers have stepped in as buyers, while share prices continue to lag behind the metal. That pattern is not random. These individuals are not betting on silver falling back to $50. They are positioning based on what current prices mean for cash flow, earnings, and balance sheets. They see the math before the market does, and they act while hesitation still dominates sentiment. This brings us back to the concept I call the Unobtainium phase. The term comes from fiction, but the dynamic is real. When a critical material enters structural shortage while demand accelerates, access becomes the constraint. Retail buyers cannot source it easily. Institutions cannot acquire it in size. Premiums rise, inventories drain, and paper representations begin to lose credibility relative to physical reality. In that environment, exposure shifts away from the metal itself and toward the companies that produce it. Mining equities become the gateway, but gateways can close quickly. Liquidity looks abundant until it suddenly is not. When multiple buyers attempt to enter a narrow market at the same time, price does not adjust smoothly. It jumps, gaps, and overshoots. This is why waiting for universal agreement is so costly. By the time scarcity is obvious to everyone, access is already restricted. The Unobtainium phase does not announce itself with headlines. It reveals itself through absence, through delay, through rising friction in places most people are not watching. And once it is recognized, the repricing is already underway. What still needed to be addressed in the narrative was the final structural layer of the thesis: liquidity. Beyond prices, margins, deficits, and institutional demand, the most dangerous dynamic for late participants is the liquidity trap. Silver mining equities trade in a very narrow market, with daily volumes that are insignificant compared to the size of capital that could potentially enter. When large funds decide to allocate, they cannot enter cleanly or quietly. Liquidity dries up, price discovery becomes violent, and gaps form rapidly. Historical parallels, such as the uranium sector, show that once institutional flow begins, small resource markets reprice brutally because there are simply not enough shares available. This creates a situation where most individual investors do not even realize what is happening until after the move has already occurred. By the time headlines change tone, valuations have already adjusted upward. The final missing piece is behavioral. Most investors are conditioned to wait for validation from authority, media, or consensus. That conditioning causes them to miss asymmetric opportunities that are visible in the data, but uncomfortable psychologically. The silver market, as described, is not repeating past cycles like 2011. The structure is inverted. Miners are undervalued relative to the metal, deficits are real, physical premiums are persistent, and supply cannot respond quickly. This combination sets the stage for a repricing that happens faster than most people expect. What we are witnessing is not just a commodity rally. It is a structural realignment between physical reality and financial perception. Silver is signaling stress not through headlines, but through absence, premiums, and margin expansion. Mining companies are generating profits that current valuations do not reflect, while the market remains anchored to outdated assumptions. When paper prices diverge from physical constraints for long enough, the correction is never subtle. Liquidity vanishes, models break, and price adjusts violently to restore balance. This is not about optimism or fear. It is about math asserting itself after a long period of denial. Moments like this are rare. They sit quietly between disbelief and recognition. By the time certainty arrives, the opportunity is usually gone. What remains is not the question of whether repricing will happen, but whether it will be understood before it is forced upon the market.